What a day, guys. Alibaba completely sold off today with the stock now down almost 17% in the past 5 days. And longer term investors are in a world of hurt, being down approximately 51% year to date. And to be honest, I think much of it is due to how fast information is actually moving. So this leads me to the question, has this created an opportunity with the Alibaba options chain? Let's look into it. You're watching More Money? Let's get it. You guys already know Alibaba completely sold off today with the stock down now almost 17% in the past 5 days, and it's now down approximately 51% year to date. And I do believe that it's due to how fast information is moving. For example, on December 1st, Bloomberg wrote that China was planning on banning VIEs. Then literally the same day, a Chinese regulator denied the news reports, but of course the former more salacious headlines got more coverage and dissemination. Now guys, just because I've been on top of this, it made little sense to me that China would just abruptly cancel all VIEs, but of course you can never underestimate the stupidity of governments. But with that said, it actually took me a moment of looking into it to find out that the Chinese regulator actually issued denials. So if someone's just reading the headlines, guys, they absolutely have the potential to be indirectly misled through the inefficient dissemination of information. You honestly hope that that doesn't happen, but it is a reality. Now, these inefficiencies can create pretty valuable opportunities with the options market. And of course, when it comes to option strategies, I pretty much stick to the basics. I'm pretty much what you would call the Tim Duncan of options. I stick to the fundamentals and basics, nothing flashy. But being from Toronto, I really wish that I had the ability to be flashier, kind of like the Vince Carter of options. The way that that dude would dunk on a guy who's 7 foot tall with his balls in his face. Just savage. But alas, I stick to the tried and tested boring cash secured puts and covered call strategies. To keep the video somewhat short, in this video I'll cover the cash secured put chain here, and in the next video I'll cover the covered call chain. And just a reminder, on our monthly Patreon calls, I actually go through the options chain opportunities each month for many companies. So if you wanted to learn more about generating a monthly income with options investing and talk about it every month, join us. The link to the Patreon is in the description below. Okay, as we move into the cash secured put chain, don't forget to smash that like button and let's go. With the shorter dated cash secured puts, I'm seeing annualized yields of approximately 100% with the January 7th, 2022 $110 CSPs giving a premium of approximately $10.50. And yes, that would be for the 1 month time horizon. Of course, with this, you only have the downside protection of approximately $10 a share. So if the shares do decline further into the $90 per share area, you'll definitely be in the red. But if you're like me and valuing the company at approximately $300 a share, you really don't care about buying the shares at a net $100 per share price. 6 months in, it gets a bit more interesting with the June 17, 2022 110s with a premium of $18.50, which is an effective 31.3% annualized yield. It also affords more downside protection so you can withstand a further decline into the 90s should the shares get that low and stay there midway into next year. I really believe that the 6 month cash secured puts is kind of the sweet spot here. That takes us into the 1 year cash secured puts, which I'm less excited about, as the December 16, 2022's 110 cash secured puts are yielding $23.50 in premium, which reflects an annualized yield of 21%. Now don't get me wrong, this is very good, but relative to the 6 months, you're not getting much credit for holding the cash secured puts for an additional 6 months. Now going into 2 years out, the Jan 19, 2024's becomes a bit more interesting as the 110s are yielding close to $30 a share, which reflects an annualized yield of 13%. Now, this isn't the greatest, but it's giving you a ton of downside protection as your net purchase price is close to that $80 a share. So if you're valuing the company at approximately $300 a share and you're able to get in at a net purchase price of approximately 1/4 of your valuation, it becomes an insanely compelling opportunity. Now, before you guys kill me in the comments below, I absolutely understand that this particular opportunity isn't for everyone, nor is it the most efficient use of your capital as you're only generating 13% a year in annualized income to wait. But because the net purchase price relative to the valuation is so low at 1/4 of your valuation, it is a compelling opportunity for the right people under the right portfolio strategy overall. Now, you keep hearing me say that I'm valuing Alibaba at approximately $300 a share, but what some of you may not realize as you are new to the channel is that I actually give away a free to download valuation model on Alibaba, no strings attached. I also do a line-by-line walkthrough of the valuation model to show you how I get to that $300 per share valuation, which you can grab right here.